Good evening, everyone. You're here with David and Lawrence on another one of our monthly webinars. So thanks very much for joining, taking some time out of your Tuesday evening to hear what we have to say. As usual, we're just going to give um, everybody a chance to log in. So we'll start the presentation in about 5 minutes, just 6:05. Again, giving everybody a chance to just get logged on. And yeah, in the meantime, please post your name, where you're from, and what you're hoping to get out of the session today in the chat bar so that we can start to get to know you. Fantastic. I know the screen share is on, but I want to be able to see who's all here. Paseka, nice to see you. Michelle from Cape Town. Sharon, hi there. Sophia, Yeben, Adrian, Donovan, Barry, Sherwin, Percy, Japolo. Nice. Cool, guys. Thanks so much for joining again. I see a couple of new faces, like easy, a couple of old faces or names. Um, cool. Hey, Imran. Sure, we've already got 81 people in, so that's great. Thanks for being on time. Umpo from Joburg, Bruce Lee from the East Rand, Jerry from Pretoria. Nice to see you guys all. Also, if you wouldn't mind posting maybe an expectation that you have, like Precious, the first step to wealth. That's what she's hoping to get today. Candace from Durban, thanks for joining. Fantastic. Mateus from Cape Town, Edgar, Johannesburg. Nice to see you guys again. If you have any specific expectations that you're hoping for to get out of the presentation tonight, please also pop that in the chat bar. Okay, Bruce, you've been putting it off for a while, hoping to get some clarity on how and what your next steps are. Okay, I'm looking to find the right guidance tools for investing. Great. How to acquire positive cash flow by to let. Awesome. Clinton Middleton, calling from the treadmill. Fantastic, sir. That's what we call the no extra time. Doing two activities at the same time. Very productive use of your time. Awesome. Thanks for joining. I see Sharon's got no sound. Is there anybody else that's not hearing? I know that's a strange question. Maybe just let me know if you can hear me. Louis, developer looking for some tips on getting started in real estate. Okay, cool. Okay, Edgar, fastest way to replace your income. Leaving the 9 to 5. Awesome. Okay, you guys are definitely on the right webinar then. Ian Jones here from China. Awesome. That's wicked. We've got internationals on the webinar. Okay. First timer, Joy. Okay, cool. Well, we'll help you through it. Fantastic, guys. Thanks so much for joining and participating. That's really exciting to see all the energy. I'm just going to grab a quick glass of water and give our last few attendees a minute or two to get online, and then we will start with the presentation. Fantastic. I think we should get started. So if you can, ladies and gentlemen, because we've already got 100 people on the webinar today, taking questions during the presentation is going to be quite tricky. So on the right-hand side here by the chat bar, you are welcome to put your questions. David will then collate that, and then at the end of the webinar, we will answer all the questions. So I hope that's okay with everyone. Let's get started with replacing your income with property. And just before I get started, Dave, can you just confirm that this will be recorded and will be distributed at the end of the webinar?
100%. The webinar will be recorded and will be up on the members portal afterwards.
Fantastic. So if you do come in a bit late or you need to leave early, this is all going to be recorded and available for your consumption at a later stage. So replacing your income with property, presented by myself, Lawrence Bull, and David McGlashan, my co-host on this webinar. So let's jump right into it. And what I'd like to start off by saying is a big thank you to our sponsors. So there are two sponsors that are making these webinars happen. The one being My Property app, which is a deal analysis tool, and I will be showcasing some of the functionality tonight. And then, of course, the second sponsor being the SA Property Investors Network. It's really great to have backing of this networking company, and they just encourage us and empower us to come and share our knowledge on this platform. So a big thanks to our sponsors. Let's quickly look at the agenda. So the first thing we're going to talk about and really setting the scene for the reason for this webinar is because the future of work and the future of employment is going to look very different today as it will in 20 years' time. So it's really about unpacking what the future of work will look like and how we can protect ourselves from the future economies. We're also going to look at financial freedom. So there was a question about leaving my 9 to 5 to be able to pursue my passions. Of course, that's a great an idea, but you need to have the financial backing to be able to pursue your dreams. So we'll talk about a concept known as financial freedom, how to create a realistic plan to freedom. So we're going to create some goals tonight as well, which is great. I'll briefly speak about how you can start raising capital for your first deal through the banks. What are they looking for, and how can you approach them? And then ending the evening off with an analysis of 2 live deals. So these are 2 deals that I'm currently looking at. Unfortunately, the one did sell a day or 2 ago. And usually the good deals do go quickly, but you'll also have a look at the other multi-let that I'm looking at the moment. So I will be analyzing 2 deals live with you today, which I think will hopefully give you some clarity on what your steps can be to become an investor. So let's start with the future of work, and also just a quick reminder, any questions can be posted on the chat bar, and then as soon as we are ended or finished with our presentation, we'll answer those questions. So the future of work. Now, if you don't know my story, I'll quickly briefly explain where I am and where I started. So I started very much like I think a lot of you on the call. I had a father that told me that I have to get a degree, get a job, work until I'm 65, then I can retire happily and follow my pursuits and my passions. So that's what I did. I studied computer science at the University of Pretoria. I got my honors. I was one of the top in my class. And I started working for a global IT company known as Dimension Data. And 3 years into this working experience, I was retrenched. And that day I realized that the system that our parents have taught us, and this idea of getting a good degree, working until 65 and then retiring happily, is actually a very old, outdated system, and actually the future of work is going to look very differently. So there's 3 things that are going to define the future of work. The one is going to be remote working conditions. I think you're already seeing it in a lot of your companies and in a lot of the innovative companies out there. Most people are allowed to work from home 1, 2, 3, sometimes even 5 days a week, working from different locations, especially with Skype and with the internet being as strong as it is today. Working from a different location or working from the office, you can still achieve the same results. The second key change that's going to come in the future of work is that there's not going to be this thing known as permanent employee. What it's going to be project-based employee. So you're going to get a project for 6, 9, 12 months with a company, and once that project is complete, you'll move on to the next project, and it might be with a different company. So the future of work is everyone is going to become more of a consultant, where they consult their services, their skills to a project for a certain period of time. Now with that comes the third key of the future of work, and that's multiple streams of income. You see, if you've got a consulting relationship with a client, let's say you're consulting to Standard Bank for a 6-month project, that's great for those 6 months because you've got income. But then after the 6 months wears out and that contract comes to an end or that project comes to an end, you need to start working on your multiple sources of income. You need to start negotiating with F&B. You need to get into property. You need to do some stocks. You need to. So that is going to be the future of work. It's going to be very much project-based skills outsourcing. Now, also another reality of the future of employment is I think we're going to have to take personal responsibility of our financial futures. In the times of our parents, it was very common to put, 10, 15, 20%, whatever it may be, into a pension fund. And I still agree with having a small portion of your investments in a pension fund. But what we're seeing is that the pension funds are failing. They're not as secure as maybe they make them out to be. Here's an example. So I was researching Group 5, and Group 5, as you know, holds a substantial pension fund for a lot of South Africans. And you can see here that Group 5 is in need of 3.6 billion Rand just to survive business rescue. So we're not exactly sure what's going to happen with the pension funds and with all that. I'm sure they've got some insurances in place and not all the money will be lost. But I just think we're in a day and age where we can't rely on a company for permanent employeeship. We can't rely on the government for grants. We can't rely on pension funds to secure us. It's actually now a time and a day where we have to become financially educated ourselves so that we can protect ourselves from the uncertainties of the future. Okay, financial freedom. And I know that maybe some people on the call have heard of this concept before, but for those of you who haven't heard of it before, let me just break it down. Financial freedom means that you are free from financial pressures. And the concept is quite simple. If you have enough passive income to equal your monthly expenses, you reach what we call financial freedom. And what that means is you don't have to work anymore, you get to work. So on the left-hand side here on the screen, you can see my guy's chilling there, drinking a cocktail, and money is rolling in, and you can see he's not working. That's the concept known as passive income. Passive income is income that comes in whether you work or not. So examples of passive income is obviously with property rentals. If you've got a tenant renting from you, they if they're paying their rent on time and they're paying it every month, you're not really working for that. You can have a letting agent who manages the tenant and you just get the rental from them. Another example could be book royalties. So if you write a book and you get it published and you sell it through a publisher, you get royalties for every book sale. So once you've done the hard work of writing the book and it's published and it's selling out there, you're receiving passive income. Online business is another passive income stream. So I don't want to dictate and say property is the only way to reach financial freedom. It's one of the many multiple income streams that you should be looking at to create that passive base. Now, when your passive income equals or exceeds your monthly expenses, that means you're financially free. And that is what really the topic is about here today is because the future of the work is looking so different, we need to start looking at multiple income streams. We need to start replacing our income with other potential income sources so that we can protect ourselves from any uncertainties. These are the three main passive income strategies that I'm following at the moment. The first one being property, the second one is online business, and then the final one is book royalties. So again, this is not just a property discussion, it's a discussion about any income stream that you can some way make passive. Even every business technically can become a passive income stream once you start to hire and employ people to do the work for you. So there's many different ways to achieve financial freedom. Let's focus on property investing. So the first step towards any kind of change in your life is to set a goal. If you want to lose weight or if you want to get more healthy and fit, the first goal you set is I want to lose 5 kilograms in 6 months. And then you can start to break down your goals. Now, because financial freedom is such a vague thing, we have to be very clear with our goals. So if you do have a pen and paper at your desk, please take it out. Or if you don't have one nearby you, but there's one in the kitchen, please just go and grab a pen and a paper. I'd like to do a quick workshop with you. So I'm just going to give you 30 seconds just to go and get that pen and paper quickly. Okay, pen and paper. And also if you have a calculator, that would be great. because I want us to set goals together. So a pen and a paper and a calculator. So the first step towards attaining financial freedom is to determine your current monthly expenses. Now, all of us have, different expenses, different lifestyle. We have, maybe some of us have kids, some of us have bonds, some of us have other expenses. So everyone's monthly expenses is going to be different. What I want you to write down on your notepad is your current monthly expenses. And the way to think about it is, if you had to lose your income today, how much would you need to be able to survive? So if you lost your income today, how much would you need to survive? So for me, in my situation, it's around 20,000 rand. That if I had to lose all of my ability to earn active income, I would need 20,000 rand just to survive. That's not going on holidays and enjoying lavish things. That's really just paying off my house, my car, my insurances, my rates and taxes, water, electricity, etc. So that's the first thing that I want you to write down. The second thing is we need to determine what that value or that figure is going to be in 5 years' time. Because the reality is, you're not going to become financially free in a week and in 2 weeks and in 2 months and 6 months. It's going to take 5, 7, 10 years. Now, the reason why we need to determine what the value is going to be in 5 years' time is because of inflation. You see, inflation happens to devalue the currency. So 20,000 rand in terms of spending power today won't have the same spending power in 5 years' time. Now, this is a very simple calculation. You take 20,000 or whatever your current monthly expenses are, and you times it by brackets 1.065 to the square root of 5. Now, what that is basically saying is 1.065 is inflation. To the square root of 5 is saying over 5 years, if inflation is affecting us for 5 years, that'll be your calculation. I've also just at the bottom below that made it a simpler calculation. So 20,000 or whatever your current monthly expenses are times 1.37 will tell you what your value will need to be in 5 years' time. So there we go. In 5 years' time, my financial freedom figure would be 27,500, because in 5 years, 27,500 would have the same purchasing power as 20,000 Rand today. So that'll give you a slight indication of what your end goal is that you're working towards. Okay. Last step is to choose a timeline. I've already chosen 5 years. 5 years here for us. As we go through the rest of the presentation, you're going to have to decide if that's realistic. Some people are able to achieve financial freedom in 2 years, some takes 10 years. It depends on the resources you have available, the experience, and the time you're willing to invest into this. Now, once you've got your financial freedom figure, let's say it's again like mine, 27,500. We need to find an approach and a strategy towards achieving that goal. Now, in my property portfolio, I focus almost exclusively on the rental residential market. There are lots of other strategies. There's some common strategies known as flips, where you buy a property at a discount, you add some value in terms of renovating the property, and then you sell it at a premium price, and you make 100, 200,000 rand profit. But that's an active strategy, and it's a once-off thing. Where what I like to focus on is on residential rental, because that's coming in every month, and that's where the passiveness comes from. Now, within my portfolio, there are two things that I focus on. One is buy-to-let, the other one is multi-let. So buy-to-let, which is on the left-hand side of the screen, that's one house, one tenant. On the right-hand side is a multi-let. That's one house, multiple tenants. An example of a multi-let would be student accommodation. Now, based on the deals that I have done, I'm more or less expecting to get about 1,000 Rand positive cash flow off every buy-to-let and about 5,500 cash flow off every multi-let. Again, I'm sure most people on the call are aware and familiar with the term cash flow. For those of you who aren't, cash flow is our term for monthly profit. So imagine that you're renting out a 2-bedroom apartment in Fourways. You're receiving 10,000 Rand rent. Your expenses, including your bond, your levies, your rates and taxes, all of that is 8,000 Rand. That means you're walking away with a 2,000 Rand profit per month. We just call that cash flow. So when you see cash flow or positive cash flow, it's just an indication of what the monthly profit is. Okay, so let's assume that most buy-to-lets are bringing about 1,000 Rand cash flow. Multi-lets are bringing about 5,500. Let's have a look now at our plan. Now, if I need to make 27,500 Rand in the next 5 years in terms of passive income, I need to purchase 27 buy-to-lets. Because if each one's bringing me 1,000 Rand on average cash flow, it's quite easy to do the maths. And now we can break it down a step further and we can say in year one, I'm going to purchase 6 buy-to-lets. So I'm going to generate 6,000 Rand passive income or positive cash flow in year one. Then year two, you buy another 6. Year three, another 6, and then you end off in year five with the last 3, and you have reached your goal of financial freedom. Now, I know you're looking at that and saying, Lawrence, how is it going to ever be possible for me to buy 27 properties in 5 years? And I do understand that. And that's why I said that 5 years might not be your freedom figure, might not be a realistic timeline for you. It's going to depend on your resources available. If I decided to go the multi-let route, I would need 5 multi-lets, because 5 times 5,500 is going to get me to my goal of 27,000. So there is just putting it in a very, if I can put an analytical term, those are the steps I need to take to reach freedom. Now let's talk about how this can practically be done. If you wanted to do the 27 properties, the capital that you would need to put in is going to be a lot less than you would think. So let's imagine that you've decided to invest in Berea, which is in the center of Joburg. You can find a 2-bedroom, 1-bathroom property there for, let's say, maybe 200,000. The rental on that deal would be 6,000. So it's very easy to see that your income is going to be far greater than your expenses. You're going to walk away with positive cash flow, which is great. Now you can approach the bank, and the bank, if your credit score, your affordability, and the deal looks good, they would probably loan you 90% of the property value. So you're going to go and buy this 200,000 Rand house. You're going to get 180,000 Rand loan from the bank. That's not your money. That's money that they're going to give you. You then need to put the 20,000 Rand deposit down. And let's say maybe you need to spend another 10,000 in terms of rates of transfer fees. What that's saying is that for every deal that you want to do, you need to put 30,000 Rand of your own money down. So 30,000 times 27 properties means the capital that you need to put in, your own money you're going to put into the deal, is 810,000. And this is done over 5 years, which means you need to save 162,000 Rand per year and invest that into your property business. Now, when I look at that, that doesn't intimidate me as much anymore. When I first looked at 27 houses, I thought, geez, that's going to be impossible. How would I ever do that? But the reality is, because we can leverage from the banks and we can loan from the banks, we actually only need to put down 10 or 15% of the property value. So the reality is, if you can raise 162,000 Rand per year, you're likely to be able to do 5 buy-to-lets in the Berea area. If we look at the multi-lets, based on the experiences that I've had, the money that I would need to put into a deal would be about 150 per multi-let. The rest I can get loans from a bank or potentially a private investor, which again means I need to raise 150,000 Rand per year in my business, invest that into property to purchase the 5 multi-lets. So if you do have the time and the interest, I'd like you to, after this workshop or after this webinar, on your notepad, just to write down what your specific goals are. So if you need to earn 30,000 Rand, use the same principle. That means you need to buy 30 buy-to-lets. 30,000 times 30 means you need 900,000 Rand of your own capital. Divide that by what your timeline is to figure out what your savings needs to be per year to be able to generate this freedom. Now, the big question that always comes from this, because I think you can all see that it's possible, it actually seems quite realistic. It's just, how am I going to get the bank to loan me 27 properties? So let's talk about financing, and specifically financing with the banks. Now, what the banks look at when they want to finance or when they want to loan you money is they first look at your affordability. What that means is they look at how much do you earn and how much can you afford to pay. Because the thing is, the bank, if you buy a property and you put a tenant into that property, the bank wants to know that if that tenant doesn't pay, you in your personal capacity can still pay the loan. So the high level calculation that they do is they look at a third of your salary. If you're earning 30,000 Rand per month, they say, okay, well, about 10,000 Rand can be used to pay off your loan. So we'll give you a loan to the equivalent ratio of 10,000 Rand, which would most likely be around the million Rand mark. So that's a way in which they'll look at your affordability. Second, they'll look at your credit score. So, how have you paid credit before? How is your Woolworths account, your Edgar's account, your credit cards? Do you pay on time? Are you a high risk candidate, a low risk candidate? And then finally, they look at the deal, they look at the property. So this is where you might find some challenges in Berea because Berea does have some high risk areas. So even if your affordability and credit score is great, if the building or the apartment you're looking to buy is in a building that's been hijacked or that is not insured, the bank won't give you a loan. So those are the three main criteria that a bank looks at. Now, the challenge that we have is that we've been conditioned to believe um, in the wrong investment philosophy. So let me explain this again using the bank analogy. Before I got educated and really took investing in property very seriously, I followed the same principle that my dad and everybody around me thought, which is buy a property, hold it for 5, 10, 15, 20 years, and then hope at some time you make money. So before getting educated, this was my first ever deal. It was a two-bedroom apartment in Fourways. The purchase price, 850. The rental on this deal was 9,500. And that's how the estate agent seduced me into buying this property. She said the yield on this property is 13%. Now she's not wrong because 9,500 times 12 divided by the purchase price means I've got a gross yield of 13%. Sometimes they'll tell you it's the net yield, which is actually just them lying or maybe not understanding the concept. This was my monthly expenses. So I got a bond, 90% loan, levies of 2,900, rates and taxes, water, electricity, insurance, and then every month 10% of my rental went to about 780 went into a maintenance pot, which I used to just maintain the property. So here I'm losing 3,300 rand per month. Now I thought this was normal because this is what everybody out there has told me is that you're going to buy a property, you're going to hold it for X number of months, and eventually at some point it's going to make some money. Now the problem with this is when you go to the bank is going to look at this and say, okay, so you're not earning, you're losing 3,300. So let's say you're earning 30,000 rand per month. The bank is going to take a third of that as your affordability. Then they're going to look at this liability that you just bought and said, okay, you're losing 3,300. So of the 10,000 that we were going to loan to you, maybe we're only going to loan 7,000. And that is how people get stuck. They buy 1, 2, 3 properties that are all negative cash flow, draining money out of their pockets. And when they go back to the bank, even though their credit score is great and the deal makes financial sense, the bank says, your affordability is the problem. Now, the strategy that I'm employing here is all around making sure that this deal makes financial sense from day one. So let's look at a deal in Berea. Berea is in the center of Joburg. You can buy a two-bedroom property there quite easily for 200,000. The rent would be about 6,000. Your monthly expenses, bond, levies, all of those things included equals 5,050. You've now increased your affordability. You see, now you can go back to the bank and say, you've loaned me on a third of my salary, but I've also got this 950 that's coming in. Can you give me a loan now on this 950? And the strategy here is that you can actually increase the amount of leverage and the amount of debt you take from the banks as long as you are buying positive cash flow properties. Now, please note on the Berea investment, I have put 10% aside for maintenance, I put 10% aside for management, and 10% aside for voids. It's very, very important that you do budget for maintenance. It's going to happen. For a managing agent, you don't want to be going to Berea every time you need to do an eviction or collect rent. And also voids. Your property is not going to be full 12 months of the year. So you're going to have to budget that there are going to be periods where your property is empty and you won't be earning that cash flow. Now, that's the difference in the philosophy. If you're focusing on the left-hand side on the Fourways investments, you're going to run out of affordability and the bank will maybe loan 1 or 2 deals to you, but eventually they're going to say you cannot afford more. If you follow the Berea investment, you can continually leverage from the banks, making sure you buy the right deals and continually grow until you reach that 27 or 25 or 20 or 100 properties, whatever it is that your lifestyle demands. I'd also recommend going to ABSA's website. ABSA's got a great buy-to-let product where they are interested in working with investors, and for them there is not a limit in the amount of loans you can get as long as you are continually buying positive cash flowing properties. So that is my golden nugget for you tonight around raising finance with the banks. Make sure that you're buying assets that bring you money from day one, as opposed to drain money from you from day one. Okay, now how do we find a deal? This is definitely the $1,000,000 question. And I've got 4 keys to finding a good deal for you. First one, you have to find a location that fits your strategy. Most of the time when a student comes to me and says, I can't find a deal or I'm bumping my head, it's because they're trying to find a deal. They're trying to force a strategy in an area that doesn't work. So for example, if you're looking at student accommodation, say that student accommodation is the area or the strategy you want to be focusing on, it would make very little sense looking in Fourways for a good student deal. It would make little sense looking in Sandton for a student accommodation property. It would make little sense in buying in Somerset West. You got to be looking at the student areas. You got to be looking at Stellenbosch, Tux, UJ, Brixton, West Dean, Auckland Park. I only know the Joburg areas, unfortunately, but go do some research and find out where the student areas are. If you're looking for buy-to-lets, they're going to work in high-density, low-income areas. Berea and Hillbrow, the center of town in Johannesburg, is rife with great opportunities because there are 2 people for every bed. That pushes up the rental amount, that pushes up the demand for rent, and thus the rent goes up and it overcomes your monthly expenses. If you're looking for multi-lets, it also is in low-income areas. Joburg South is very good for multi-lets. You're looking at Lenasia, Rosettenville, Kenilworth, Forest Hill. So when you're struggling to find a deal, maybe it's because the strategy you're trying to apply to the location isn't the right strategy. So that's my first tip. The second tip, you have to find high motivation. Something that we also teach a lot in our seminars is that you have to buy low. So if a property is worth $1 million, in order for you to guarantee making money in property, you need to buy it at 700. And the only way that you can buy at a huge discount is when someone's motivated to sell. So someone going through a divorce, a retrenchment, some sort of financial difficulties, a property going to auction, those are examples of where the motivation is high. So if you're looking for that, I'd recommend going to an auction. I wouldn't bid on the first time, maybe bid on the third or fourth time. Make sure that you view the property beforehand. There are some challenges with auctions, but that's a great way in which you can find highly distressed properties. Number 3, there needs to be equity in the deal. Now, equity means the difference between what the property is worth minus the outstanding debt. So if you've got a property that's worth $1 million, the loan or the bond that you have on that property is 600,000, you are sitting on around 400,000 Rand worth of equity. Now, why that's important is, let's imagine that you find a property that you want to buy, and you're going to put in an offer of 700,000. It's worth $1 million. You're going to put in an offer of 700,000, but they've got an outstanding loan of 800,000. Even if the seller says yes and agrees to the deal, the bank is going to say no because the bank needs their 800,000 Rand out. So with motivation comes equity. If you've got the right amount of equity in the deal, you can go lower with your offer and thus protect yourself and get a good deal. And then lastly, to find a good deal, you have to use your calculator. You have to use financial metrics to make a decision. It's not about walking into a house and saying, "Oh my gosh, this feels so good." It needs to make financial sense as well. So let's quickly talk about the key metric that we as investors use to determine if something's a good deal or not. And then I'm going to end this webinar with a live analysis of the 2 deals that I'm working on and also field your questions. So return on investment, ROI, this is the decision-making criteria. This is what's going to give you the confidence to say yes, it's a good deal, or no. So return on investment is basically taking your profits into account and your money in the deal. So let's go through an example. Let's imagine that you're looking to buy in this area. It looks like it's in the center of town. The arrow is pointing to a 2-bedroom, 1-bathroom property. The market price of this property, it's worth 1 million, but because the seller is very motivated, they're about to go to auction, we can come in and agree a purchase price of 600,000. So we're buying it at 600, even though it's worth 1 million. The buying cost. Now, when you buy a property, there are certain buying costs applicable. As you can see there, the first in brackets is 600,000 times 0.0 because we have to pay a 10% deposit. Our LTV, which is just under the purchase price, that's loan to value at 90%. What that's saying is that the bank is willing to loan you 90% of the value of the property. So 600,000 Rand is what we deem the value of the property. The bank will loan 90% of the 600. We have to then put 10% down ourselves. Plus the other 65,000, that is usually your transfer costs and your bond registration costs. Maybe we have to renovate the property to bring it back to market condition. It might be slightly run down. Holding costs, so we're going to hold the property for 3 to 6 months before we can resell it or before we can get a tenant in. So during those 6 months, we have to pay levies, rates and taxes, electricity. So those are the costs that we have to incorporate in this deal. And then selling costs. Of course, the estate agent is going to sell the property on our behalf and they're going to take a commission off the property. So the money that we have in the deal would be our buying costs, refurb costs, holding costs, and selling costs. So you can see that the total of the money in this transaction of your money, not the bank's money, is 300,000. Now you could, of course, approach an investor, a private investor, and loan the 300,000 Rand from them. In that case, you would have zero money of your own in the deal. The profit is then quite simply R1,000,000 minus 600 minus 300, meaning you're left with 100,000 Rand. So we're assuming here that you're going to flip this property. You're going to buy low, renovate, and resell at R1,000,000. Basically, the 600,000 Rand is what you bought it for. That's a cost. 300,000 Rand is what you're investing into the property. So your profit on this deal is 100,000. Now let's work out if this is a good deal or not. So the return on investment on this deal would be your profit divided by the money you've put in, your money in the deal, because you want to work out the return of your money that you've put in. So 100,000 Rand is what you're making from the property. 300,000 is what you've put into it. So 100 divided by 300 times 100 to make it into a percentage means that you are making a 33.3% return on investment. 33% means that you will receive your money back invested in 3 years' time. If the return was 50%, it means you would receive your money back in 2 years' time. If the return was 100%, you would receive your money back in 1 year's time. So you can just start to get a sense of how hard your money is working for you. The best advice I have here for you is compare to the banks. See, we've all got a bank account. We're all making a certain interest off our account. So you might have a market link or a savings account where you're earning, I don't know, between 5 and 8% interest on your money. With this deal, you're earning 33%. Now, property has obviously got risks and there are some challenges. Now, if you're getting a return of, let's say, 5 or 8% on the property, I would highly recommend that you don't do the deal and you rather leave your money in the bank, because in the bank, your money is secured. You're getting the 5 to 8%, you don't have to worry too much about it. But if the property is bringing you a 15, 20, 30% return, it means you're more than doubling, sometimes tripling how hard your money is working for you in the bank. If you're getting 5% in the bank, but 15% in a property transaction, it means your money is working 3 times harder for you in the property deal than in the bank. And that is where the risk of doing property meets the reward, and I'm willing to do the deal. So you always need to compare to what are you getting at the banks. If you're getting 5% at the bank and you've got a potential to do 15% in a property deal, that might justify you taking the risk of taking your money out of the bank and rather putting it into a property transaction. Let's look at it now from a cash flow point of view. So we looked at imagining if we were going to flip the property, how much profit we make and what the return would be. Let's now assume we're going to buy the property and we're going to hold it. We're going to rent it out, give it to a tenant. So again, the market price is R1,000,000. Purchase price 600,000. Our loan to value, again, 90% at a 10% interest rate. Our buying costs are exactly the same. Our refurbs are the same, and our holding costs are the same. The only thing that changes is you won't have selling costs because you're looking at holding the property now. You're not going to actually sell it. So your money in the deal is 1 plus 2 plus 3. Your buying cost, refurb, and holding cost. The rest is supplied to you by the bank. This is the cash flow statement. So let's assume we're making 15,000 Rand worth of rental per month off this deal. The expenses would be the bond, the levies, the rates and taxes, insurance, monthly operating expenses. We're walking away with a cash flow positive of 4,000 Rand. So our income in terms of rental is 15. Our expenses in total is 11, which means 15 minus 11, we're left with 4,000 Rand monthly profit. Now, how do we know what the return on investment on that one is? It's quite simple. Step 1, you annualize the cash flow. So you take the 4,000 Rand cash flow that you're expecting to make, times it by 12 to get an annual figure. In this case, it's 48,000. Step 2, right? You take the profit, the annualized profit, the 48,000, divided by the money you've put in the deal, times 100. Remember, the money in this deal is slightly lower. It's the 225 because you don't have the selling costs. So 48,000 divided by 225,000 times 100, you're left with a 21.33% return on investment, which is actually very high for a buy to let. On average, the buy to lets that I'm seeing these days are between 10 and 12%. So if you're getting a 21% return, that's a really, really positive one. Okay, let's get practical. I think you guys have had enough of a theory lesson. Let me show you some actual deals. So I'm going to open up this link, and I'm going to hope you guys will be able to see it. Okay, I've got my phone with me. So David, if for some reason the thing does not display or something goes wrong, please just WhatsApp me, and then yeah. So this is a 2-bedroom apartment flat for sale in Berea. As you can see, it is currently sold. It is a good deal, I think. So it's 32 Abel Road. Let's have a look at some of the pictures. So that is the building on the outside. And this is very standard kind of conditions that you would see in Berea. Okay, so there's a bit of tiling work to do, which is, again, as investors, we get quite excited when we see this because the more distressed or the more dilapidated the property, the higher the likelihood of the person being motivated and willing to sell it to us at a discount. Yeah, so that's the kitchen still. That's the bedroom. So if you haven't been in Berea before, this might shock you, but this is a very, very normal condition for Berea. What they'll often do is they'll turn a bedroom into 2. So here you can see there's a bed and there's another bed, and they've just put a curtain in between to create like a division. So often what happens in Berea is you'll rent to one person for 5,000 Rand per month, let's say, and they will then sublet their room and their TV room to another 2 people for 2,500 Rand. And they'll end up essentially living for free. Um, so I'm seeing here that the slideshow is stuck. So let me just reshare. Sorry about that, guys. Let me reshare. Okay, just give me a second. Okay, let's see if this works. So you should be seeing, let me just restart here. You should be seeing a property 24 slide or picture and a 2-bedroom apartment in Berea. I'm just waiting for confirmation from Dave that that you guys can see it now. Okay, so Dave, I'm just waiting for you to send me a WhatsApp to say that it's all good. Good now. Okay, so I'm assuming that he can see it, that you guys can also see it. So this is the property that I was talking about, 195,000 Rand for a 2-bedroom apartment, 32 Abel Road in Berea. Let's have a look at the pictures. So that's the picture of the outside of the building. Again, it's not in terrible condition. That's the kitchen of Berea. Like I said, it's quite a standard. It seems maybe a bit run down, but right, in Berea, people just want a functional kitchen. They want to lock up and go. They want to be close to public transport so that they can get to work. Again, there's a little bit of work that needs to be done here, a bit of retiling. Um, but again, the more dilapidated the property, the higher the likelihood of the motivation of the seller, and means we can get potentially a good deal. Again, a picture of the kitchen, one of the rooms. And here was the room that I was explaining where they'll put 2 people in one room. So here's the room, and in general, here's a bed on the left and there's a bed on the right, and they've just put sort of a curtain in between. Because this allows them to share the rental, right? So if the rent for the whole apartment is 6,000, but they can put 3 or 4 people into that house, it means that they reduce the burden of how much each person has to pay. So there's another bedroom or another bed. Not sure what's going on here, to be honest. Hallway, you can see very old parquet flooring. The bathroom does need quite a lot of work. Or actually just really the retiling, as long as it's functional. As long as it's functional. And you can see what's great about this photo is that you can see the property is lived in, which is fantastic. So if we go down, we can see here attention renovators slash investors, the spacious 86 square bedroom, blah, 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 blah. Estimated monthly levy is 1,800. You'll notice that when you are investing in Berea, the levies usually kill the deal. Estimated rental income of 4 to 6,000 Rand. I'm quite confident that you can get 6,000 Rand because you already saw one of the rooms was divided into two. Okay, so let's analyze this deal together. And what I'm going to do is I'm going to open up our app, which is myapp.property. You are welcome to register. There is a free month trial that you can try out. Let me log in here and we're going to go to analyze a deal. We're going to analyze a buy to let. Okay, so I'm just going to quickly wait for David to give me the heads up that you can see my screen and that it's on the My Property app slide or section. Okay, Dave, let me just get the confirmation from you that this is, let me see, from the chat bar. Okay, so it's stuck on, oh, sorry guys, that's a little bit annoying. Let me try and reshare again. Okay, let me go to, I'm going to open up the entire screen, share. Okay, so what you should see now is a dashboard page. Let me go to the welcome page. So you should see a page that says welcome to the My Property app, Lawrence Bull, and it's got 4 tabs to it. So again, I'm just going to wait for David to give me the heads up on that one. You can see it. Okay, so we're going to start here by going to analyze a deal, analyze a buy to let. Okay, I'm going to add new deal. Okay, so let's have a look here. Oh man, I'm so popular with all these messages, eh? Okay, cool. Everybody say, I'm getting messages from everybody saying it's back up, it's back up. That's great. Okay, so we're going to start you with the asking price. So if we go back to our deal, it's going for 195,000. So it's going for 195,000. Remember, as professional investors, we always come in with a lower, cheeky offer. So let's say we were going to go in with an offer of 150,000. That's a 23% discount. You want to be anywhere between the 15 and 20%, 15 and 25% discount. Okay, the agent told us that we can make about 6,000 Rand rent. Maybe what you do as well is you go to TPN and you find out from TPN that actually in that area you can get rentals of 6,800. And maybe you also speak to, or you do a wind deed report and you see that actually most people are getting 5,600. So here it's just telling you the average of those 3 numbers. You should be expecting about 6,133 Rand. Okay, now we're going to go through the 7 steps. That was the first step. The second step is the buying costs. So the buying costs, remember I mentioned that when you buy a property, there are certain costs involved. So if you click on this button, click here to get accurate buying costs, it'll open up uber.co.za, which is an application that you can use to determine your buying costs. So if we say the purchase price here is 150,000, we're going to get a loan from the bank of 90%, so that means 135,000 will be our loan. Okay, are we buying a freehold, which is a freestanding property, or are we buying a sectional title? We're buying a sectional title because it's an apartment in a block of flats. The seller is not registered for VAT, and we're going to buy it in a company name, for example. Click calculate, and it will tell you what your total costs are. So it's saying your bond registration costs are just over 14,000, your transfer costs are just over 8,000. So here's the total amount. Let's call it 23,000. So just to keep it simple, I'm going to put here in the first tab 23,000. Fantastic. Then we go to the refurb tab. A refurb tab has got here all the different types of renovations you might require. What we did see is there's probably about 2,500 Rand worth of tiling, maybe 2,500 for painting. The flooring also needs a bit of work. Let's assume the kitchen needs about 2,500. And we're going to put a contingency of 20% in place. So yeah, a budget of about 10 to 11,000 Rand will get that apartment back to tip-top shape. Other costs, these are things like if you're planning to do an eviction or rezone or holding. I don't expect much to happen here except for maybe a 5,000 Rand holding cost. We might hold it for a month or 2 while we're renovating. Now we've got the finance costs. So we're going to go to the bank. We're going to ask for a 90% loan. So they're going to loan us this amount. We're going to pay a deposit of then 10%, which is 15,000. Let's assume they're going to give us a 10.5 interest rate. The bond will take 20 years to pay back. So this is what we have to pay the bank every month for the next 20 years to pay back this loan. Okay, let's work out the cash flow, which is, does this deal make financial sense? Now the levies, they said the levies is 1,800. The rates and taxes for a property like that will be around 250. The building insurance will be included in the levies because it's an apartment block. The voids, okay, so voids is the cost of not having a tenant in your property. Now I have pulled the TPN report for Berea, so I know that the vacancy rate or the chance of having a tenant leave and then not replacing that tenant is very low because there are 2 people for every bed in Berea. So it's a great high demand area. So I'm going to use a void percentage of about 4%. So I'm assuming 4% of the year the property is going to be vacant. For the rest of the time, it's going to be chock-a-blocks full. Management fee, you can get a managing agent to manage the property for 5% of your rental if you get a home loan with ABSA. So let's assume that you've gotten a home loan with ABSA. And a maintenance provision, we're going to put maybe 7% aside. Okay. So what you're seeing here is your rental, money coming in is 6,100. On the left is all your expenses. You're left with a monthly profit of 1,708 Rand. Okay. So if we go to the summary tab, here is where it tells us that this deal, as it currently stands, is a 38.10% return on investment. That is fantastic. That is fantastic. Maybe I have been a bit conservative with some of my estimations, but let's assume that this is right. Now, what you can do with the app, which is quite interesting, is you can project or predict what the future of this deal will look like. So let's assume that over the next 20 years, expenses are going to increase by 6.5%. That's the rate of inflation, right? Water is going to be 6.5% more expensive next year. Electricity, food, all of that stuff. Let's say that the rent in that area is going up by 8% per annum, which is the trend that we're seeing in Berea. The discount rate, don't worry too much about that, and capital appreciation will be quite low. What the app then does for you, which is really exciting, is that it does a 20-year projection of an ROI for you. So it tells you in year one you're making 38%, but as you hold this property, and because the rent is going up so much higher than the expenses, you're starting to make more and more and more and more money off this deal. Similarly, here you can see the income, expenses, and cash flow. So in year one, yes, you're making about $1,000 to $2,000 per month cash flow. But as you hold the property for longer, you can see the green bar being the rental goes up a lot higher than the red bar being the expenses. And the difference between the green and the red bar is your cash flow. So as you can see, holding this property over an extended period of time, means you're going to increase your cash flow and increase your profit of this deal. We've also put a couple of other interesting things on the app, things like an equity gain. So this just tells you, how your property is going to do over, again, a 20-year period. We've put some indicators in place, your monthly operating ratio, your debt service coverage ratio. And we've also done some scenarios where if your bond interest rate had to change or if your rental income had to change, how would it affect your deal. And I know that this might seem a little bit overwhelming. We have created several tutorial videos where I take you through deals to explain what all these different indicators mean. For our discussion tonight, what's important is to look at this ROI, 38.1%. For me, if I viewed the property and I felt comfortable in the deal, I would have done this deal hands down. Makes a lot of financial sense. Um, so there we go. That's an example of a buy to let, one tenant, one property. Let's now have a look at our multi-let. Now I'm going to have to maybe reshare my screen because every time I change applications, it seems to go haywire. So let me just quickly stop sharing. Okay. Okay, and I'm now going to turn on my screen and okay. So you should see again property24.co.com. So I'm just going to again wait for Dave just to give me the thumbs up, or anyone who has messaged me in the past. Good. Okay, so you can see this is property 24. This is an area in Rosettenville. I was in Rosettenville about a week ago, and this was one of the properties that I looked at, Larry Court. It's a 9-bedroom townhouse for sale going for 1.895. So let's have a look at some of the pictures. So that's it on the outside. Again, from the outside, and you can see it looks like it's quite well in good condition. This is inside one of the units, so there are 6 units on this specific block. Again, another photo of the inside. So you can see it's empty, obviously, which means that you'll have to find a tenant for this property, but the demand is so high there it shouldn't be a problem. That's the kitchen. Not in great condition, not in terrible condition. It looks like it's a functional kitchen. Maybe a little bit of a touch-up would be nice. Again, the kitchen looks fine. You can actually see that this has been recently renovated because the paint is new, the tiles look new, it looks like in good condition. But you can see also, just saw that now, the door here on the right, you can see that there's no handle. So you might need to replace some of the doors. The cupboard, very clever photo of this because she's not showing you the estate agent is not showing you the inside of the cupboard, which is where you'll often see where the damp problems are. Those are new cupboards, which is good. It's a terrible photo. Bathroom looks like it's in good condition, which is great. Yeah. That's on the outside. The garage. Again on the outside. And that's the garage. The big challenge with this property, and the reason why I wouldn't do this one, is because of the roof. If you can see the photo that I'm looking at now, it's number 2 of 18. It's a flat roof. And that is just calling for all kinds of damp issues. So if it wasn't for the flat roof, I would have put an offer on this deal, but unfortunately that has killed it. Anyway, let's analyze it as if we were, what's this now? Okay. So 9 blocks, investor's dream, and what you can see here is the current rental and expenses are as follows. So there are 6 flats going between 3,700 and 4,500, and then there is a bachelor flat right at the bottom. The expenses, rates and taxes are 980, insurance, caretaker, etc. Okay, so let's go back to our calculator. I'm going to start a new deal, and also again, just message me, Dave, if for some reason the screen stops sharing. Let's add a new deal. And let's see if this multi-let is going to make financial sense. So, first step, the asking price is 1895. Okay, remember we never offer the full asking price. We always come with a discount. So I'm going to go in, let's say 135. I know that's quite a heavy discount, but that roof is for me a very big problem. If we look at the rental, so let's assume that the rental per average per room is 4,200 times 6 means you're going to be getting 25,000 for the flats plus 1,700 for the caretaker's room. So you're making about 27,000 rand per month rental of this deal. Okay, step number 2, again, we do the buying cost. So we click here, it takes us to our Uber app. The purchase price is 1350. The bank is going to loan us again 90%, so that's about 1.2 million. It's this time it's a freehold because it's a freestanding property. The seller is not registered for VAT, and we're buying this one again in a company's name. So our transfer costs or our buying costs are now sitting at 74,000. So I'm just going to pop it in here, 74,000. We go to our refurb costs. Now I have viewed this property and the damp problem is huge. So I'm going to put here about a 50,000 Rand damp proofing solution. I would probably also do some internal doors of about 2,000. Let's look at some of the kitchens, maybe 15,000 in the kitchen. Painting, I think repainting the house would be really nice. We put another 10% contingency. So we're looking at about, 100,000 Rand would be our renovation cost just to get this back onto tip-top shape. There wouldn't be any other costs on this one because the tenants are all good, so there would be no evictions. Finance costs. Okay, so we're going to get another 90% loan from the bank. We're going to get it at 10.25 interest rate over 20 years. So that's our monthly costs. That's our monthly financing costs. Let's look at this cash flow from a monthly point of view. Okay, so there are 0 levies because it's a block of flats. There are no levies. Levies are only applicable in apartments. The rates and taxes, as the estate agent said, is about 980. I'm just going to make it 1,000. The insurance on this one is 550. Now the voids, the vacancies with multi-lets are traditionally higher than that of a buy-to-let. So I would say in this area, it's not in the best area in Rosettenville. It's slightly higher risk, but the demand is very high. Let's work on a 9% void cost. The managing agent that I have in Rosettenville charges me 9.2%, including VAT. So I'm going to make that the management fee. And in the maintenance provision, let's go with a conservative 7%. Maybe a bit higher actually. Let's go 9%. Now what you can see here is your rental is 27. On the left hand side is all your expenses. Your monthly cash flow is 5,800. So I'm hoping you're starting to see where I got these estimations of 1,000 rand per buy to let and 5,500 rand per multi let, because that's the kind of numbers that I'm seeing on a regular basis. If we go back to the summary tab, the return on investment of this deal is a 22.46%. It kind of seems like a no-brainer, but again, that roof for me was absolutely deadly. I don't want to deal with damp issues. I don't want to deal with that kind of stuff. Now, again, if we do our projections, we can see how this deal will do over a period of time. I'll just say calculate. But what I wanted to quickly show you, another cool feature of the app, is that you can generate a investor proposal. So on your summary tab here under overview, there's a button that says generate proposal. So if you click that, it takes you to another section of the website, and here's where you can now start to build a professional investor document, which you can take to a bank to raise money, or you can take to an investor to raise money. So I'm going to do this very quickly because we've got lots of tutorials on the app that shows you how to do this in detail. I just want to show you the end results. So I'm going to just put some pictures in there. Let me just quickly add one or two pictures. I'm just going to show you the end result. If this makes sense and excites you, go and check out the app, go check the tutorial videos. It's all shown to you and are highly detailed. What I'm doing here is I'm just adding a few pictures of the property so that you can see what it is that you are investing in. Okay, fantastic. So I'm going to generate a detailed proposal. It takes a couple of seconds, and now it takes all the information that you've inputted on the different fields, and it's going to spit out basically an investor proposal. So here it is on the bottom left. It's busy generating. I'm going to ask to open it when it's done. Just give it a couple of seconds. And there we go. This is now a professionally designed investor proposal, which you can use to raise the financing from a bank or hopefully from a private investor. So all it does is it takes your logo, puts it onto the front page. Here you can see the executive summary and the high level property values. So the asking price is 1.9. We bought it at 1.3. That's the discount, return on investment, gross yield, net yield. Those are the key indicators. There's a small introduction of who I am. Here are some of the pictures that I quickly included. And then here it's got the cash flow. So it's showing you the rental, 27, the expenses, and then the monthly cash flow. So this is what you can take to the bank and say, look, I would like to increase my affordability by 5,500. Of course, the bank's not going to just give you more money. They want to see this over 6 or 12 months. They want to see, you actually running this business to loan on it. You'll see the buying costs, the refurbs, the financing costs. It puts the scenarios in place. And it even's got the projections here. So you can see the 20-year ROI projections, the cash flow projections, as well as your contact details. So yeah, guys, that's why we built the app to one, help people analyze deals with more confidence, but also once you've analyzed the deal, you've gotten the yes, to put together an investor proposal. Oi, keeps getting stuck again. Sorry about that, guys. So I'm not exactly sure what you've seen or what you haven't seen. Let me restart. I don't know why it's doing this. It's very annoying. Okay, let me try again. So I'm just going to assume that you've all seen up until the investor proposal. So just quickly again, if you haven't seen this, this is what the app has generated. The first page is basically a front page, cover page with your logo. Then it's got some information about the high level property values, so the asking price, the offer price, the discounts, etc. There is a personal introduction of me, which is standard on the app, and it will just pull that information every time. Here are some of the pictures that I've just quickly included so that you can make it a bit more visual. Here are the cash flow numbers, so you can see the rental, the expenses, and the profit and loss. And there it shows that you're making 5,800 rand per month. Here's again some tables of all the information. So all the numbers we've put in, it's just pasting that down for you. And then here on the last page, you can see what the return on investment projections would be over a 20-year period, as well as the income expenses. So the reality or the reason behind the development of this app is one, to help and empower people make wise investment decisions, and then number two, once you've got a decision or a deal that makes financial sense, to generate a proposal and help you find the capital to raise the money for that deal. See, with this document, it's 7 to 10 pages. If you go to the bank or if you go to a private investor, it's going to make quite an impression on them when you don't just come with an idea, but you actually come with almost a business plan and a proposal for this to work. So, ladies and gentlemen, that's my story, and I'm sticking to it. My goal is to always get you out at 7 o'clock, an hour. To make sure that you can still go on and have the rest of your evening. What I am going to do now is ask Dave to put all the questions up, and we'll start targeting those questions one at a time.
Cool, Lawrence. Let me just really get the first question up over here.
Also, while we are answering questions, ladies and gentlemen, you are welcome to leave if you do need to go and feed your kids, or you need to go and do whatever it is to do. You're welcome to. We are recording this, and it will be on the members portal.
Cool. So first, the question is about determining high-risk areas.
Okay. How do you determine high-risk areas? I've considered Hillbrow, Berea, and Yeovil as high-risk areas. So that's a great question. I would use a TPN report. So go to tpn.co.za. They basically put together all the information on what areas are high risk and which ones are low risk. Funny enough, Hillbrow, and Berea are quite low risk. They've got a default risk ratio of about 8%, meaning that 8% of the time your property is going to be vacant, where Yeovil is quite high. Yeovil's sitting at about 20 to 25%. So go check out tpn.co.za. They've got all the reports that tells you which areas are high risks, which ones are low risks. Great. Next question, Dave.
Does my property have allowed printing?
Does my property app allow printing? Yeah, so essentially that proposal that I just generated, you could save that as a PDF document and then print that at a printer or at home.
For the Berea deal, if one had the capital to pay cash, would that be wise?
Well, that's also a very good question. I think that's actually a great question. Why don't I quickly check that, because I'm not sure. Can I quickly put my screen on again, Dave?
Yep.
Because the question often is, does it make more financial sense to pay cash, or does it make more sense to get a loan? So going to my dashboard here, so I can go and look at the deals. Buy to let, this was the Berea deal.
Your screen's not sharing, Lawrence.
Okay. Let me try and reshare again. Okay, let me go here. I'm hoping you guys can see it. Hey Dave, can you see it?
Yeah, you're good now.
Okay, so here is the deal as we had done before. So what I'm going to do now is I'm going to go to the summary tab, and we see here that the ROI is 40% for this specific deal as is. If we now go to our finance costs and we say, actually, we're going to make it 0, so we're going to get no loan from the bank, our return on investment now becomes 19%. Sorry, it logged out there. Is 19%. So actually getting a loan from the bank for this specific deal will make more financial sense. Let's have a look here if I can just show you quickly what I mean by that. Okay, so all that I did is at the finance cost, I changed. Oh, that's the wrong deal. Let's have a look here. Here's the deal. Sorry, here's the deal. So as it currently stands, if we had to get a loan from the bank, the return on investment on this deal would be 40%. If we go to our finance costs, we put in 0 as a loan to value. We go back to the summary tab. It says 19.74, which kind of makes sense because you're putting more of your own money in the deal, which directly affects the return on investment. So I think, a good question, and what I'd recommend is analyze a deal with money from the bank, analyze it with your own capital, see which one is bringing the better return, and then make, an educated financial decision out of that. Okay, next question.
Next question is, any ideas on how to turn a negative cash flow into a positive cash for existing properties within like a year or so?
I mean, I guess probably the main idea would be to increase the number of people in the house. So if it's a two-bedroom and you currently have one person living there, could you rent out the other room, maybe earn an extra, 2, 3 thousand rand, and maybe that gives you a break even, cash flow break even. Maybe extend the length of your loan. If you go from your loan from 20 years to 30 years, it reduces the amount you pay per month. That might help you with cash flow.
Hmm.
Otherwise, if you're sitting on a negative cash flowing deal and it's not in an area that is a good area that's going to appreciate, I would just say take the loss, sell it, and reinvest it in the right area.
Shahid is asking about how we structure our deals and what are we structuring if we're doing our personal names, that sort of thing.
Do you want to take this one, Dave?
Yeah, I mean, I can't speak for Lawrence's portfolio exactly, but structure is one of those things that everyone wants to ask about and everyone wants to get worried about early. So my first bit of advice is maybe do a deal before you drop 50,000 Rand on structuring yourself correctly. And assuming you've got your first deal under your belt, then yeah, our general strategy is to have trusts which hold companies, and the companies are the trading entities which own and purchase the properties. That's our general way we go about this, but everyone has their preferences. It's going to change based off of what you want and what you need and your
Yeah.
life goals.
Yeah, and don't get too tied up on the structure first up. Rather, just invest in property, get a deal, and then once you've got wealth to protect, then look at a structure.
Jeff is wondering if you could talk to him about how to become a sourcing agent.
Sure. I mean, aren't you going through this process, Dave, with your broker
Nope,
license?
no, I'm not. It's not the same.
Okay, so for those of you who don't know, sourcing is essentially the middleman between a distressed seller and an investor. So you basically find a motivated seller, get a good discount, package the deal, and then you sell it to an investor for a certain fee. My advice for you, Jeff, is find a good deal that makes financial sense, and then attend a networking event. Attend South African Property Investors Network. There's networking events happening all over South Africa. Come with your proposal document. Come and meet as many investors as possible and try and sell your deal. I'd say that's the best way to get started.
Yeah, and I think we've already answered that question. Essentially, yeah, I trade in limited companies to reinforce risk, and I use trusts to hold my limited companies for tax efficiency and for again asset protection. How do we turn that negative cash flow into positive cash flow? So, kind of asking the question second time. I think let me just reinforce what Lawrence said, if you don't mind, Lawrence. Um, at the end of the day, cash flow is a result of income minus expenses. So the only way that you could change the cash flow results of a property is to either reduce the expenses or increase your income. Those are the two levers you have. So that's what you have to look at. You have to look at reducing the expenses or making more money. So Lawrence's suggestion is make more money because it's hard to reduce expenses on property. But that's pretty much the gist of how to get a negative cash flow asset, positive cash flow, and then obviously to reduce expenses, you can restructure finance. Um,
Yeah.
Percy. Lawrence, Percy wants to know. She's thanking me. She didn't thank you. Where do you start? What are the first steps? So let me quickly grab a link over here for you, Percy.
So where do I start? Like the first steps. Sure. I think before you buy or even think about buying a property, you need to spend a year educating yourself. So I would definitely go to the link that Dave's put there, the propertycoach.online. I'd go to as many networking events as possible. I'd continually look at these webinars and read books on the property market, because the problem with property is if you do make a mistake, it's a costly mistake. It's usually big numbers that you're working with, and if you make a bad purchase, you're going to be sitting with that bad purchase for a long time. So my advice would rather be invest in your education, get yourself a coach, join the online coaching program, the link that Dave put there. Learn from someone who's done over 700 property transactions, being Andrew Walker. And once you've learned what you need to learn, then go out there and find the deal. Um, that's gonna get you started.
100%.
Cool. Any
I
other
think
questions?
That's mostly it from what I'm seeing. Matoka's got a question here that I'm not quite sure what they're referring to. So, Matoka, if you can give us some clarity on the offer at hand, can we use it once the OTP is accepted? Lawrence, does that make sense to you?
The offer at hand, can we use it once the OTP is accepted? I'm not quite sure what that means.
Okay, good. Not just me. Look, so I think, Lawrence, that seems to be the end of the question. Numbers are dropping. Yeah, I think if anyone does have any questions, obviously that's what the support systems are there for. So the Facebook group, email, we're here to help you, to let us know. Oh, wait, Joy's got a question for us. There you go. Joy, I think this is a good question to end on, Lawrence.
Where and how do you find distress sellers? That's definitely a big question. I think the challenge is, guys, we focus on people who are struggling. You know, that's kind of the sad part of the business we're in. We find people who are motivated to sell because with motivation comes discounts. So you really need to be targeting people who have property problems, and people who have property problems are people going through a divorce. You know, they've just bought a house together with the person that they love, and now they're going through a divorce. And now this property that they shared together has become a problem, and they're willing to sell that property for a discount because they just want to get out of it. People going through retrenchments, people relocating. So I think the way you find a distressed seller oftentimes is through an estate agent. You know, most people who are trying to sell, even if they're motivated, go through an estate agent. The first question that I always will ask an estate agent when they're bringing me a deal is, why is the owner selling? And if the estate agent doesn't give me a reason that makes me feel like they're motivated to sell, then I'm going to walk away, because you know, if they don't have a reason to sell, there's no discount, there's no way in which I'm going to make money out of property. So I think the way to find distressed sellers, maybe just also come to our networking events. You'll learn a little bit more about that. Go to auctions. Auctions is a great way to find distressed sellers. Go to Facebook groups. I'm sure there's lots of divorce and debt counseling kind of Facebook groups. You can maybe go on there and write a message that says, I'm a property problem solver or provider, whatever. If you have a problem with your property, please contact me. So there's ways in which you can do it. I think for now, focus on just meeting the estate agents and asking that question, why is the owner selling? If it's not because they're relocating, divorce, financial difficulties, or some other valid reason that would motivate them, then the chances are you're probably not going to get a good discount.
And our next webinar is on deal finding strategies for new investors.
Oh, yeah, perfect.
So perfectly done. I think that's the end of the question, Lawrence. I think we can call it there. Thank you very much.
Yeah, guys, thank you. And as Dave mentioned, this will all be on the members portal. He's put the recording there, members.sapropertynetwork.com. We'll also be putting it on the My Property app tutorials page, so you guys can go check it out there as well. Otherwise, the next webinar will be, do we know the date for the next one already, Dave?
It's on the screen. 6 deal finding strategies for new investors, 10 September, 1800.
Fantastic. Hopefully we'll see you guys there. And yeah, thanks for being a good audience and for engaging as you did.
Awesome. Cool. Thank you very much, Lawrence.
Thanks, Dave. Cheers. Bye.